Did you know that one country controls roughly 90% of the world's rare earth processing? Now imagine an ETF that owns rare earth miners from everywhere except that country. That's REXC. Here's why Wall Street thinks this fund could be one of the most important launches of 2026. REXC stands for the Sprott Rare Earths ex-China ETF. It launched in April 2026 on the Nasdaq, and it's the first and only ETF on Wall Street that gives you targeted exposure to rare earth companies while specifically excluding businesses domiciled in or primarily operating in China. Sprott is the same issuer behind URNM, the well-known uranium miner fund. As of late April, the fund holds about $9 million in assets. That's small, but it's growing fast for a brand new niche product. The launch is timed to one of the biggest geopolitical stories of the decade. China has tightened restrictions on rare earth exports, and the rest of the world is scrambling to secure its own supply chain. The fund tracks the Nasdaq Sprott Rare Earths ex-China Index. Under normal conditions, REXC invests at least 80% of its assets in companies that derive at least half their revenue or assets from mining, separating, refining, or producing rare earth minerals. The portfolio is currently 36 stocks. The expense ratio is 65 basis points or 0.65% per year. The top holding is MP Materials, the only operating rare earth mine in the United States, at about 20% of the fund. Number 2 is Lynas Rare Earths, the largest rare earth miner outside of China. Other big names include USA Rare Earth, Arafura Rare Earths from Australia, and Iluka Resources. Here's what they don't tell you. With only 36 holdings, REXC is highly concentrated. The top 5 names alone are roughly 57% of the entire fund. If MP Materials misses earnings or Lynas has a production issue, you are going to feel it. And rare earth stocks are some of the most volatile names on the entire stock market. A single news headline can move these miners 10 or 15% in a day. That volatility isn't a flaw. It's the trade-off for the structural opportunity. Rare earths are essential for electric vehicles, smartphones, wind turbines, and military hardware. Western governments are spending billions to break China's grip on these critical minerals. Investors who want a piece of that story have to live with the noise. If you've been on this channel before, you've seen us cover REMX, the VanEck Rare Earth and Strategic Metals Fund. REMX is bigger, more diversified, and includes a meaningful weight in Chinese miners. REXC is the opposite. Pure ex-China, smaller and more concentrated. Same theme, opposite implementations. One owns China, the other deliberately doesn't. REXC is for the investor who specifically wants the geopolitical bet, exposure to the Western rare earth supply chain, free of Chinese domicile risk. It's not a core holding. Think of it as a satellite position, somewhere between 3 and 7% of a thematic sleeve. This is not your retirement plan. A $9 million asset base means you should watch the bid-ask spread closely. And brand new funds with niche themes can shut down if assets don't grow. That's a real risk to keep in mind. If you found this helpful, hit like and subscribe. We cover a new ETF every single day. And drop a comment with this question. Would you bet against China's rare earth dominance, or do you think they keep their grip? See you in the next one.